Hello everybody, as I'm recording this video, we are at all-time highs. The S&P 500 is trending higher and higher and higher. We just learned that we will enter a new environment with a lower interest rate environment. I mean, this is the new norm now, so a lot of things will change. And the big question is, how do you find opportunities when everything is expensive? How do you buy stocks? Which stock do you buy if everything is going up? Is everything is expensive? This is what we are going to talk about today. In case this is your first video from this channel, welcome. Thanks for choosing me. My name is Christophe Nour and I'm French, and I've been investing in the stock market for almost a decade, and I have achieved a performance of 25% per year investing in quality stocks. So we do GARP investing, quality investing. You only pick good stocks. And for this past decade, we have reached all-time highs after all-time highs after all-time highs. And if I became worried in 2019, I would have sold in 2019 and I would have missed out on these first gains. The first thing I want to say is normally stocks go up. We are in a new environment since the 80s. Normally, stocks go up in the long term. All the innovation of the world is happening in the US. All the earnings growth is happening in the US. It's not happening in Europe. It's not happening in Asia. Everything is happening in the US. If you look at the margins, well, everything is happening in the US. The improvement of margin is just spectacular. And let me show you proof of what I say, because I recently found this very good example of how margins can go up over time. I have it here. Okay, wonderful. So now I have this chart to show you. Even before talking about finding opportunities, for all the people that say that the PE ratio is high for the S&P 500, if you look at the Schiller PE ratio, everything is sky high. To some extent, it is deserved because margins are high. If you look at the net margins of the S&P 500 in the 90s, in 2000, in 2010, we are at a very good level. And for the past 2 decades, 3 decades, margins doubled. At the same time, the PE ratio went from 16 to 26. Actually, if you look at this way, we are not that expensive. Okay, I wanted to start this video by saying, yes, we are a little bit expensive, but to some extent, we have better qualities now, better quality companies now that are growing more, that are more profitable. We have a recurring business model here. Most of the businesses we have in the S&P 500, most of the tech companies are having a recurring revenue stream that is coming. And this recurring revenue stream is giving us visibility. Okay, so you pay a premium valuation for businesses with a strong visibility in future earnings. Okay, so that was for the first point. Secondly, I want to check this newsletter from Stock Unlock because I'm a contributor to this newsletter. We are 2 writers for Stock Unlock newsletters, and every other week this is me writing the newsletter. And why not make a content and comment on this newsletter so you can get more information and additional comments. So what I'm about to do now is read this newsletter, comment on it with new anecdotes that I have not shared in this article. So next time you subscribe to this newsletter because it's great. And I don't know if this format will work. So let's start finding opportunities in an all-time high market. This is the latest newsletter I have written, and I think it's pretty good in this current market environment because things are getting frothy, things are getting hyped up again, and a lot of people ask this question. The market is screaming higher, headlines say new record, you have a lot of people saying we are in the too expensive territory, and people don't know what to do. This is basically my introduction. But What I'm saying is, under the surface, there is always dispersion. You always have stocks that are going down. I mean, look at Lululemon, look at PayPal, look at many businesses that don't want to go up. The stocks don't want to go up, literally. Some sectors lead, others lag. Some themes get crowded, others get ignored. So there is a small adjustment from Stock Unlock that is doing wonderful updates, so really looking forward to using this. By the way, you have a link in my description to use Stock Unlock in case you want to use this wonderful website. It's one of the best websites you can have, actually. I mean, and if you click on my link and register with my link, you can get a discount, like a 10% discount, 15% discount, so it's great. Okay, why all-time highs do not mean no value? Prices move faster than fundamentals in the short term. As you saw since 2022, things can go really fast. And in 2023, people already said we are too expensive. At the same time, it was the beginning of AI. And at the time, nobody knew what AI would bring. You could have called AI a bubble because companies invested massively without any returns. And now, since 2024, 2025, we start to see the return on investment. So sometimes companies will invest massively in CapEx to boost the free cash flow in the future. You never know what will happen. And since 2023, people are screaming that the market is too expensive. Well, for those people who sold, it's been 2 years of agony. Let me continue. When the market believes earnings will rise faster, think of all the tech giants, a higher multiple can be fair. This is what I told you at the beginning of the video, right? You have better growth, better margin profile, so they deserve a better multiple. At the same time, other stocks are getting crushed. You can name many companies right now that don't want to go up. The stocks don't want to go up. Some great companies are in a temporary trouble, and it might get scary to invest in them. It's always like this, and these short-term problems are sometimes great opportunities to buy cheap stocks. You clicked on this video for stock tips. You clicked on this video for potential ideas. Let me go through a couple of them. Okay, I talked about Lululemon. Let's start with this one. You all know Lululemon. You have a lot of videos on YouTube about Lululemon. I will not personally invest in this one because it's an apparel company and I don't like this. But it's getting cheap right now. It's getting excessively cheap right now. You have a PE ratio of 10, 12 for a business that is still profitable. The growth has stopped. But if you believe the problem is temporary, this is a golden opportunity to buy. This is a company that is doing buybacks. This is a company that doesn't have a debt problem. This is a company that is profitable. This is a company that is growing. This is a company that is in a fashion trend, in the apparel category. The industry, I don't like this industry. This is the reason why I would not personally invest in this one. But for a lot of people, I understand why people are buying. And as the market is screaming higher and higher and higher, Lululemon is getting destroyed. So it's false to say that you don't find opportunities in this new market. Everything is so expensive. No. Actually, Lululemon is here. You asked for a second one? Fair enough. PayPal. PayPal is cheap right now. I don't like this business model. This is the reason why it's not in my portfolio. But to some extent, PayPal is cheap. You have a business that is generating free cash flow, that is increasing the buyback program, that doesn't have a debt problem, profitable. The problem I have with PayPal is the moat. I think the moat is eroding, but still, the business is cheap. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Another business that I like, and I'm studying right now, so maybe I will buy, is Crocs. Crocs is excessively cheap. And what is great is you have Norbert Lou, a super investor that invested recently in Crocs, I believe. Crocs. Yes, Norbert Lou, a value investor that is famous for having a concentrated portfolio, has bought PayPal, Pinduoduo, and Crocs. I think Crocs is in a great position right now, and the stock is in a great position to rebound from here. It's in the apparel territory, so I don't like. But it's very cheap at the moment. So maybe as a short-term trade, it can be good just to bet on this rebound. The company is still profitable. Don't look at this negative loss right now because they just have had a write-off of their Hey Dude acquisition. The company is doing buybacks. The company is profitable. The company doesn't have a debt problem. And the company is generating strong free cash flow, which means the price to free cash flow is 6. If you think Crocs will continue to grow internationally and will continue to grow globally, this is a great time to buy Crocs. But again, this is in the apparel category. And as you saw for the past 5 years, the volatility is huge. You go up a lot, you go down a lot, up a lot, down a lot, up a lot, now down a lot. My guess is it will go up a lot because the fundamentals are still strong from what I see. But we will see. We will see what will happen. You have other stocks that are dropping. And this one I like. And this one I am buying. Fortinet. This stock is dropping. Okay, and we are not in the cheap territory, but we are in the fair value territory. Forward PE ratio of 28, price to free cash flow of 30. So the forward price to free cash flow should be lower than this. Okay, so I just given you 4 ideas. Your time to do the work now. Your time to do the research. Okay, if you want more information, we have analyzed some of them inside my coaching program. We have talked about PayPal, deep dive on Lululemon, deep dive on Fortinet, and we talked about Crocs also. Not a deep dive, but we have talked about this one. So again, if you want to chat and join our coaching program, you have a few spots available to book a call with me. You have a link in the description to have my website. You will have an informative video, and you can book a call with me directly, so we can work together. Okay, let me continue. For every stock that is dropping, each one felt scary in the moment. The drop is very scary at the moment. Then years later, it looked obvious in hindsight. Obviously, you can look at Netflix, Meta platforms, even Google more recently. It was quite scary. And I mean, this article, I will never go through this article. I mean, the number of anecdotes is a little bit too much. I mean, you tell me what you like. If you remember, a couple of months ago, Google Alphabet was in a drawdown and the stock was at 140 in May, in April, in May. And if you look at videos on YouTube and if you look at the comment section below the videos, it's a bloodbath. People are saying Google is dead. And now the same comment sections are filled with people that love Google again. Prices drive narrative. Another lesson for you guys, don't let anyone force you to have an opinion. Don't let anyone interfere with what you really think. Stop being short-term oriented. Say the stock is great when it is up and the stock is horrible when it is down. The business has not changed much. And since then, the stock is up 60%. So something like this. Be careful what you see on the internet. How markets behave at records. When indexes hit new highs, 2 things usually happen. First, volatility picks up. Well, we see what happens with the tech businesses go up massively. And we see what is happening with the hated investments, hated stocks. They go down massively. Pullbacks of 5 to 10% are common, even during strong years. Secondly, leadership rotates. Very important. You have seen what has happened with Oracle. You have seen what has happened with Broadcom. Things emerge out of nowhere and things become a leader. Same thing with Google. A few months ago, nobody wanted to invest in Google because of disruption from ChatGPT. And now everybody is rushing to the door to get in, to go into this trade. The winners of the last leg often pause, like Nvidia, while other new leaders emerge, like Oracle. If you only watch the headline index level, you will miss that rotation. Yeah, obviously, if you only look at this chart, it's up and to the right. What you don't see is inside you have each component that is moving up and down. This is where preparation pays. You do not control when a correction happens, but you control your watch list, your research notes, and your buy levels. This is great and something I work on a lot with students. How do you prepare? How do you do the due diligence on a stock before it goes down? Before we have a stock market correction? Because when we have a market correction, and we will have one, I don't know when, in 1 week, in 1 month, in 1 year, we will have a market correction. It's already too late to make the adjustments and the work. Because if a stock goes down and you want to buy, you are biased. You are not cold-blooded. You are getting emotional because you want to get in. The best moment to do the research is when a stock is at an expensive territory, at a high level. So you will take into account the positives, but also the negatives. And then, for some reason, during the next market correction, let's say in 1 year, the stock will drop. And you will have done a common sense analysis, a complete analysis with all the positives, all the drawbacks, blah, 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 etc., etc. Okay? So the best moment to prepare is before the battle. You don't want to prepare during the battle. Something very important, and we talk about this to a large extent inside the coaching program. Okay? Very important. You control your watch list. If volatility comes, you already know what you want to buy and why. Because you have your watch list. I will buy Google at this price. I will buy Amazon at this price. I will buy TPL, Texas Pacific Land, at this price. Fortnite at this price. Because if you rush to get in a trade, you are getting emotional, and this is absolutely not good at all. The risk of chasing weak companies. Oh, this is quite important. When markets continue to go up, you might be tempted to invest in promising companies without much track record. Do I dare say some names publicly because of the comment section below? Yeah, let's talk about some names. We have some YouTube videos here pumping stocks that will be potential leaders in the data center story, AI story. That doesn't mean they are bad businesses. It just means that the track record is poor, so it's a bet on the future. Let me talk about a few names. You have Iron, that is here. You have a company that, look at this, that has very little history. It's been public for 5 years. The growth is here, yes, but not much of a profitability. You have only 1 year of being profitable, and because they are very well positioned for the future, the stock is up a lot, and you have some videos talking about the future of the business. I'm not saying this is a bad business. I'm saying out of all the companies available now in this market, you have some speculative bets, some stocks that are more speculative than other ones, and this one feels inside the speculative bet, because of no track record of profitability. Another one that you can have is Open. Open, Carvana, you can have the same deal here. This is a business that has a very strange history. In terms of revenue, no major growth, I would say. In terms of net income, well, the company is known for having losses and losses and losses. Well, seems like it is turning around, and seems like profitability will come in the future. But nobody knows. Absolutely nobody knows. They are diluting the shareholders every quarter, and you have a lot of people that are bullish right now on Open Door, which has burned all their shareholders since they became public. If you had bought Open Door in 2021, everybody is losing money. The only people that were getting some money out of Open Door are people that bought after 2022. And nobody knows if this will continue. Actually, nobody knows. This is what I say. You have some stable companies in this market, like Google, and you have other speculative categories. Again, I'm not saying these are bad businesses. I'm saying in a bull market, you have some weak track records that will appear good because of the future growth prospects. And guess what? If we enter a recession, for some reason, any reason, it happened in 2022. If we have a shock in the economy, these will be the first dominoes to fall. Okay? So this is pretty important to always consider that in a bull market, when things are at all-time high, People will want more. We want more alpha, more performance. You've seen what is happening with the Palantir. People want more growth. With Robinhood, people want more growth and more. You become greedy for more growth. The truth is, it will be very hard to sustain these levels of growth. The valuations are stretched. If you look at what you see on the internet, people are very optimistic. So far, the growth is here. What if the growth slows down? And it is not priced in by most market participants. So we will see. As long as the story holds, they will thrive. But if we have a recession, which is a risk, right? Markets are still high. If we enter a drawdown in this market, markets go down, they will be the first one to fall. Let me continue. As markets continue to go up, you might be tempted to invest in the promising companies without much of a track record. A rising tide can make weak boats look fine for a while. So I talked about some leaders, but you have some clear weak companies out there that are going up. Think of all the meme stocks, meme companies that we had, like GameStop. Let me see GameStop. AMC, Nokia, BlackBerry, Virgin Galactic. Nobody remembers this. Look at this. GameStop in 2021. Up and to the right. And then no results. Everybody lost money on GameStop. No result for 5 years. Guess what? Because it's a bad business. It's a bad business model. I'm not afraid to say it. Very, very strange business model. Very, very strange investment. Look at AMC. This is even worse, actually. Did they go bankrupt? Why is the stock price 3? Maybe they went bankrupt. I don't know. I'm not sure. The stock price in 2021 went from 30 to 200, and now it is back to 3. Again, they took advantage of the volatility, took advantage of the shareholders. They literally cheated the shareholders. They lied to the shareholders. They didn't care at all, and they took all this cash, the high stock price, to raise money to invest in some mining stuff that were completely insane. And everybody that invested in AMC thinking it was a good turnaround play, well, turns out it was a good turnaround play again, and it went back to zero. Very hard, very hard. Let's talk about, you have Virgin Galactic. I don't know how Virgin Galactic is doing, actually. Virgin Galactic. Is it still here? Still here. It was a SPAC. Some companies that we see right now in 2025 are like the SPACs we had in 2021. Yeah, the stock Virgin Galactic went from 200 to 1,000 back to $3. It's always good to have these reminders, guys, to see that sometimes stocks that are often talked about can go down if they are never profitable, if the management is lying. You have many companies that were very famous in 2021, and it turned out that there were complete mistakes that you have to avoid. You have similar companies right now that are sexy, all the computing companies, all the quantum mechanics, quantum computing companies, all the biotechs that you have right now that are trending, there will be zeros. I have no doubt in this. Be careful, and sometimes when you see a lot of opportunities like this, it means a correction is near, which is quite bearish. That does not make them seaworthy. Be careful with businesses that depend on constant capital raises, carry heavy debt without strong cash flows, or lack any real moat. We've talked about GameStop, AMC, these are good examples. These names can bounce hard in a hot market, then fall even harder when the crowd moves on. This is all about fading away. You have hype that is fading away. We saw this movie already. Fast gains, then slow pain. Your age is patience and quality. This is what I preach for all my clients and everybody watching my videos. You want to avoid mistakes. The goal is not to be a genius. The goal is not to sound smart. The goal is to make money And the goal is to only pick winners, to avoid stupid decisions, to avoid mistakes, to avoid as many errors as possible. If you avoid mistakes and you focus on winners, quality investing, the worst thing that can happen is a mediocre performance. That's it. You will not lose money. And the best case that can happen is you make a 25% per year. Okay? So the upside is there to only invest in winning companies without much debt. I mean, I look at AMC. It was the best case example of a horrible business in the cinema theater industry that completely died because of COVID and because of the streaming services. Not profitable at all. They did not recover their revenue over time, even after COVID. In terms of net income, since COVID, they have never been profitable. They are filled with debt. They burn the free cash flow every year. They dilute the shareholders every year. How many red flags do you want? But you had people that willingly invested in this, saying it's a great value play, it's a great turnaround story. I've seen the tweets, I've seen the videos. People don't remember because it was maybe 4 years ago. You have similar opportunities now that are scary. And I'm strongly forecasting bad things for these kind of stocks. And if in your portfolio you have such specific stocks, good luck. Let me continue. Avoid the trap of thinking a low price equals a good deal here, obviously. Cheap can get cheaper if the business model is broken. Focus on fundamentals, balance sheet strengths, customer stickiness, and the path to durable profitability. If those pillars are weak, the pop will not last. Exactly. Where the real opportunities are, this will be quite interesting. There is always a hunting ground. You just have to define it. Here are a few practical places to look when the index is at a record. First category, very simple, what I preach every day here, quality that corrected quietly. Think of Fortinet. Think of MSCI. Look for solid companies that hit temporary headwinds, a product cycle delay, like this was for Fortinet, a messy quarter, you have plenty of examples like this, or a headline that spooked investors. If long-term demand, margins, and balance sheet trends are intact, a 20 to 40% drawdown can set up a great entry. For some people, it's their Lululemon here. Second category are secular growers outside the spotlight. Not every compounding story lives on the front page. You have some companies that are doing great, but nobody talks about them. The HVAC industry is a good example. Buy at a reasonable valuation and let time work. For example, let me give you some names to thank you for clicking on this video. You have a few names in the HVAC category that are very promising and that will benefit from AI, but still nobody is talking about them. The first one is Comfort System. Look at the stock price, literally up and to the right, following all the AI names. But this company is growing margins. But this company is, look at the revenue growth, insane double digits revenue growth. But look at the net income, up and to the right. No cyclicality, no year in the red. Every year was profitable. They don't have a debt problem. Actually, now they have more cash than debt. They generate more free cash flow every year. Look at this in the blue. Free cash flow every year. And every year, they are doing some buybacks, some acquisitions, some buybacks. Do they pay a dividend? A small, tiny dividend. Okay, almost no dividend. And everything now is available at a P ratio of 30, forward P ratio of 29. After the stock popped. Actually, inside my coaching program, we have talked about Comfort System in March when it was trading here, saying it was a great opportunity. Some people inside the coaching program invested in this one because we did the work. Okay, I was following the company for quite a while, and here was a very good time to buy this quality company available at a good price. We'll see how it goes. Another company. I'm thinking about HVAC companies, but they do electrical stuff, mechanical stuff. Anyway, you have MCore. MCore, same vibe, same industry, I would say. Lower valuation, forward P ratio of 22, and the difference is capital allocation. Comfort System is doing acquisitions, and MCore is doing more buybacks, which I love. Okay. You have another one called Linux International. I've been following this stock for 6 years now. And similarly, you have growing margins, improving profitability. You have something that is growing the revenue a little bit and growing the net income by much more because of better margins, better efficiency. The free cash flow is growing, and nobody's talking about Linux International. They are doing buybacks. The debt problem is manageable, I would say. They, for example, they have $700 million of free cash flow compared to $1 billion of net debt. So not a lot of debt problem, I would say. PE ratio of 21. Nobody talks about this one. You have opportunities that will benefit from AI and data center build out, but they are not sexy at all. I mean, who loves the HVAC industry? Look at another one. Look at Vertiv Holdings. It's lovely. It's about cooling data centers. So cold fluids available at a forward P ratio of 28-29. So the track record is quite poor. You don't have a lot of information. But similarly, something that is growing rapidly in a promising industry. I will not touch it this one because of the lack of track record, which I don't like. But this is a winner that is profitable. Okay? And the margins, the business model is deadly simple actually. Okay, let me continue. Third category, cyclicals early in their upcycle. Certain industries move in cycle. When supply tightens or pricing power returns, profits can bounce faster than the market expects. I would argue it's hard to pick the bottom of these stocks. Yeah, it's always hard to pick the bottom for cyclical companies. Think of housing, car makers, housing companies, everything related to wood. The key is to avoid balance sheets that will not survive the down part of the cycle. Strong operators with conservative debt loads can surprise to the upside. I can give you some names here. You have Simpson Manufacturing here. That is creating wood connectors for houses. And you have a company that is following the housing industry, so you can get some cyclicality regarding costs. But this is a company that is very good, I would say, with a very strong balance sheet, forward P ratio of 20. Nobody likes Simpson Manufacturing. You have another one, and I'm blanking on it. Similar company, actually. Anyway, too bad. You have companies that are cyclical. For example, you have also Louisiana Pacific. The hard part is picking the bottom, actually. Louisiana Pacific, same thing. We are in a cyclical industry, and when the industry is good for them, when they make a lot of profits, they make a lot of buybacks. And actually, Warren Buffett invested in Louisiana Pacific. I also did, and I made a lot of money on Louisiana Pacific. Okay, so this is a company that, when it is thriving and generating a lot of free cash flows, in 2021, they bought back 19% of their shares in 1 year. In 2022, they bought back 16% of their shares. Okay, so we are talking about cyclical companies that are the best on what they do. You can also look at coal miners. I can tell you, Monish Pabrai is invested in met coal companies. And I am following Monish Pabrai into AMR, Alpha Metallurgical Resources, and seems like this is a turnaround play. Every quarter, I check what is happening. It's a small part of my portfolio. And for the past quarter, things have improved immensely. We have discussed this inside the coaching program. I won't go in details here, but seems like it is the bottom. We start to see some signs of a bottom. Maybe it will go back down, but if things go correctly, I would say, for these kind of companies, anything in the met coal industry, I would say, things can get very bullish, and I will be here. Let me continue. 4. Spin-offs and cleanups. Corporate actions create mispricing. New spin-offs get sold for non-fundamental reasons. Divestitures simplify a story and reveal hidden margins. Plenty of companies that are moving away from some part of the businesses. So plenty of spin-offs there. And special situations with clear catalysts. You can think about the IPO market too. As I'm recording this video, you have Waterbridge that just IPO'd. And something to maybe look at. Maybe look at this one. It just IPO'd. It's very recent, but you have to do the work. How do you see if this is a good business or not, etc.? This is where being a quality investor helps, because you know what is important and what is not important. Okay, there is a simple hunting process. Keep it boring. Keep it repeatable. Screen smart, not wide. Start with free cash flow yield, so valuation, you want something that is cheap. Net leverage, you don't want a balance sheet with a lot of debt. And return on invested capital, you want efficiency. Add revenue durability, not just growth. You want to invest in companies that are growing their revenue at a sustainable pace and for many years in a row. You don't want 1 year of profitability. You want to sustain profitability for many years. Read the filings, especially the risk section and the footnotes, the debt terms, etc. Map the customer, who are the customers, the stickiness of the product, of the service, and you set target prices. Buy zones. You do the valuation work now, not during the sell-off. You pick your levels and size positions in advance. This is actually very important to be prepared before the battle. And you use a checklist. As always, the thesis, key metrics, what is important, the red flags, what are the 3 things to monitor. Another tip for you. For all the companies, you have a few indicators, a few KPIs to monitor that will impact the stock price. For example, for some companies, you have only 3 things that make the stock price go up or down. So you have to know these 3 things and monitor these 3 things. Very easy. Very simple. If you don't know what are these 3 things, it means you don't know enough about the company. You do not need to time peaks and bottoms to win. You do need a system you will actually follow. This is why I say you keep it boring, repeatable, keep it simple. Really keep it simple. I've been averaging 25% per year with a very simple process. And so far, I should be at large outperformance of the index for 2025 with a very simple process. You don't need to make things complex, actually. This was also the goal of this newsletter, to just keep it exactly simple, to the point, fundamental, because it works. You don't need to be a genius. If you have a framework and you know what to do, you can do it. One more point, buybacks, debt refinancing, and project spending often improve when conditions are favorable. Strong companies take advantage of that. We have mentioned a few quality companies during this video. Some companies can take advantage of market volatility to do smart buybacks or to do smart leverage. If you have a strong management team, you have an edge. They reduce share count, lower interest costs, invest in growth and attractive returns. If you own these type of businesses, volatility is not an enemy. It's an opportunity to own more. So the key takeaways are to build a watch list, do the work, focus on great businesses that will compound through cycles. When the next pullback hits, you will not be guessing because you will have done the work. You prepare before the battle and you will be ready. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. click the first link in the description below to get more information. You will get a video, a short video that explains how everything works completely for free. No need for your mail address, just click the first link in the description and I'll see you on the other side.